This worksheet video is all about financial statements and how we prepare and how we format all of our different financial statements. So what we are going to start with is our income statement. The income statement is always prepared first, and it includes our revenue and our expenses, and we end up with net income on that particular statement. The information that we get from the income statement as far as net income or a net loss will then move to the statement of owner's equity. And so that statement is prepared second. And it's really just looking at the changes that happen to capital from our beginning balance to our ending balance. And then we come to the third statement, which is the balance sheet. And it's pretty much the basic accounting equation that we're looking at assets equals liabilities. And it is looking at the capital portion of our owner's equity. And so that's the third statement, because the total you're going to get from the statement of owner's equity for capital is going to move forward to that balance sheet. And so I want to look at a worksheet. This worksheet is very, very much like the one that we did for our closing entries and for our post-closing trial balance. So I will refer back to that for some of these items as well. So what we're going to look at, again, if you remember when we were doing closing entries, I pretty much had you kind of draw a line where we had capital come across, and then I also had you draw a line underneath that capital account, and that just kind of separates those permanent accounts and those temporary accounts. And it also pretty much separates some of our deals, what we look at with statements. Because what we have here is our revenue and our expense items. Those are going to be on our income statement. When we look at cash all the way down to capital, those are going to be balance sheet items. And then when we look at the capital and the drawing accounts, that looks at really that statement of owner's equity. And so that's where the information is going to be coming from for all these. Again, the first statement we prepare is that income statement. And so what we look at with all of our statements is we are looking at the header for our statements. And so for our header, what we're going to have is you have the company name. So we look at ABC Company. You will also look at the title of the statement. So this one is an income statement. So you would have that title, and then from there you would have a date. Now remember that our income statement is a for the period statement, because we're looking at a whole period of time, not just a day. And so what we would have here is, for, in this case, for the year ended December 31st, 2019. And that would be the header that you'd be looking at. As far as the actual statement goes, what you're going to have is you're going to start with your revenue accounts. And so you're going to have that title of revenue. You then are going to indent over and list out your revenue accounts. So in this case, we only have one revenue item, so I would put service revenue in. And then I'm going to come over and I am going to put the total. And so the total that I have here for service revenue is going to be $31,900. If I had more revenue, I would list those out. I don't, so now I'm just going to come in and then over and have my total revenue. Now the one thing that I want to make sure that you understand with this process is that when we are doing statements, we do not have debits and credits. We only have different columns. We could have one column, we could have two columns, we could have 3 or 4 columns. It really just depends on that particular statement. So now I come in and I'm ready to move to my next statement, and what you'll see is that right under expenses, I'm just going to come kind of down. And when I move that down, I am going to have my new category, and that new category is going to be my expense category. And so then I'm just going to list out all of my expenses. So, and that really is just going to kind of come and be right underneath this as well, because everything just kind of flows down. So I'm going to have salary expense. I'm going to have repair expense. I'm going to be listing out supply expense, depreciation expense, and gasoline expense. Now, with all of these items, I am going to have another column, and when I start a column, I always start it with a dollar sign. And so salary expense was at $4,500, repair expense is at $800, supply expense is going to be at $1,600, depreciation is at $1,000, and gas is at $3,800. So now I'm going to put an underline here because I do want to add all of those items up, and that is going to give me a total expense column. When I look at my total expenses, that is going to be $11,700 if I add them all up. So I do have that, and then I'm going to come back in. Now, net income can be in a couple different places. It could be over to the side. It could be indented in more. It's done a couple of different ways. What we see for net income is we just draw a line and then we put our net income. Net income will need a dollar sign because we are finishing up this particular statement. Our net income here is $20,200. So when I come in, I'm going to put that $20,200. Now, I don't really have enough room to really show you this, but what I'm going to just kind of move it over for you so you can see it. That $20,200 needs to have a double underline. All right, and it needs to have a double underline because we are finishing this particular statement. So, you know, if I had left myself enough room, which I wish I had of, what I would see here is that double underline would just come in right here, and it would just be a double underline. And so that is what your income statement would actually look like if you were looking at that income statement. The other thing to look at here that I kind of want to show you is how our closing entries and our income statement kind of go together. And so what we look at with our closing entries, and if I kind of just go back and look at what we had done in the closing entry section, you'll see that this goes together. So our R is our service revenue, $3,100. The total that was in our income summary is the total revenue. For our expenses, if you look at all of our expenses come in, when you add them up, the total expenses are going to be what that income summary amount was. And then my net income, if you look at it, notice it's $220, and that is what I had in my income summary, and that's what actually closed. So you have the R and the E do work very closely with your income statement. The next statement that we want to look at is that statement of owner's equity. So with the statement of owner's equity, I'm just going to kind of do it over to the side. So we do have ABC Company. This is the statement of owner's equity, and I'm abbreviating there. This is also for the period statement, so I'm looking at for the year ended December 31st, 2019. Okay, so what I'm looking at here is I am looking at the I and the D part of this and how it works out, and we'll look at that in just a moment also. But for this, what I need to know is I need to know what my beginning capital balance was. And the reason I need to know my beginning capital balance is that's that first part of this particular statement. Now you'll have a note out there. What we are going to assume in this one is that this is a brand new company that just started this year. So if this company just started this year, then my capital balance starting capital balance is going to be 0. The other thing that I then would look at is when I have my statement of owner's equity, I do have to add some things to it. And those things that I'd be adding to it would be the owner contribution or any owner investments that the companies had. I would also add, if I had a net income, that actually would be added in on this section too. So this $3,000 is a brand new company. Since I have money in capital, that means that the owner did invest that money. So I'm going to have a dollar sign because I'm beginning a column for that $3,000. And then the net income is going to be coming from that income statement. And so what we see with this, when we're looking at this amount that we got, that $20,200, is going to come right up here. And so when I look at that, I'm going to have that $20,200. Then I'm going to take and add those two items together, and I am going to, once I add them together, I'm going to move that total over. And so what I'm looking at here is that $23,200. At this point, I'm going to come up with a subtotal, so I'll take my beginning capital, I add it with those additions, and so I'm still at $23,200. The next part of this particular statement is going to be a less part, and that less part that we look at, we are going to be looking at, we have to subtract out any owner withdrawals, which are as part of that drawing account. And so if we look at our drawing, we notice it is at $12,000. So that means that the owner did take out $12,000. So I'm starting a new column here. I have the $12,000 with a dollar sign. If I had had a net loss and did not have a net income, it would be on the minus, not the addition. And that actually would just kind of come there too. Is how that works. In this case, I don't have a net loss, so that number is going to be a 0. But I just wanted to show you how it worked. I'm then going to take and add these two together and move that total over. And so what I'm looking at here is that $12,000. So I'm figuring out what my ending capital balance is going to be. I would take the $23,200, I would subtract out the 12, and that is going to leave me with $11,200. So now I'll look at that dollar sign, double underline, because I have just finished that statement out. Again, we can see how this does relate with those closing entries, because this does work with the I and D closing. So what you see with this, we started with a 0 balance. The owner put $3,000 into the company. We then had our closing of our capital account here to it, which gave us that $23,200. Then we had to close out our drawing account to capital, so it subtracted out. We did not have a net loss, so that would be the $12,000 there, and that gives us a balance of $11,200, which in fact is what we see, is what our balance is after we finished all of our closing entries. So that is a large part how all of this information will work together. That $11,200, once you've finished with that and you are ready to kind of move on down, the thing to remember here is that this amount is going to go to that balance sheet. So it will go to the balance sheet. Sorry, can't read that real good. Is where that's going to go for our capital account. Now, as far as everything else goes that we are looking at here, what we're going to find is that our balance sheet really is just going to be that top part. And so we can list out our assets and we list out all of those different things. So I'm going to kind of move it back up so we can take a look at these different accounts here and start using them to actually do the balance sheet that I have for us to do. So with the balance sheet is set up as assets on one side, liabilities and owner's equity on another side. You can do it to where they're both beside each other, or you can do assets on top and then liabilities and owner's equity on bottom. That's how I'm going to choose to do it right now, just because of space, and it makes more sense. For this, we do have to have a header. So we are looking at the ABC company. This is the balance sheet. Now, the thing I want you to remember about the balance sheet is that it is a snapshot. It is one moment in time, which means that when we look at it, it's just going to have a date associated with it, because it's not for a time period. It's for what are the amounts right this minute. When we look at this, we will start with our assets. And remember, our assets are broken out, and we have to classify them. So this is actually a classified balance sheet is what I'm doing, because I am looking at those different classifications. So we start with current assets. The first thing that we list are our current assets. So if I come in and I do my current assets, then I'm going to list out any of those current assets, and they are in order of liquidity also. So the first one that I'm going to have is cash. Now notice what I keep doing is I keep moving over when I'm looking at these different items. So I have a header or a subheader, and then I list out those accounts in it. Also, when I'm looking at this, I'm always going to start my amounts over all the way to the right side of the paper, and then I'll move in if I need more columns. So in this, again, that is $6,800 for cash. I have accounts receivable, which will be listed, and that is at $2,000. The other items I have here, supplies. So supply is also a current asset. So I'm going to list out my supply account, and that is at $500. So that is all of my current assets. So I will come in now and I will put in total current assets. I draw a line there because I need to add these up. When I add these up, what I get is $9,300. So I do have that $9,300 for my total current assets. Other accounts that you might see an investment side. We don't have any investments here in this, but we do have fixed assets. So the next thing I'm going to look at is I'm going to come right underneath this current assets, and I am going to pull that down, and I'm going to get to that new listing. And so that new listing is going to be all of my fixed assets. So in this case, what I see for fixed assets is I do have a truck listed for fixed assets. So that's going to be the first thing I'm going to look at, is that truck. So I'm going to have truck. And again, I just want to kind of make sure everything's nice and neat and everything lines up. So when I do this, I will be listing out the truck. This is going to have a new column because I do need to pull it in so I can add some different things up and subtract things out. So I'm going to have $8,500 for that truck. The next item that we see here is the equipment account. So I am going to have equipment. And that equipment was for $6,300. So I am going to put that in at $6,300. The next thing that we have on this list, if we get ready and we look at it right under equipment, what we are going to have is we have accumulated depreciation that's at $1,000. So I am going to come in here, and this is that contra asset account. I am going to say less accumulated depreciation because that does have a different normal balance. So I do have to subtract that out. I can put it in parentheses to signify that I'm subtracting it. I don't necessarily have to though, because I do have the word less there. So I'm going to take the $8,500, add that to the 6,300, and then I need to subtract the 1,000 from that. And what that's going to do is that's going to give me a total fixed assets. And I'm going to pull that amount over to the side here because I want it to line up in a nice column. So those are there. I could also have intangible assets. If I had an intangible asset, it would just go underneath that. I don't have any intangible assets, so I don't have to worry about that for this particular one. So I'm finished with my whole asset section, so now I'm able to kind of go in and I can put my total assets in. So if I just come in and dent over yet again, and I can put my total assets. And looking at my total assets, I do need to add my current assets with my fixed assets. So when I go through and I add these, what I'm going to end up with is 23,100. So $, double underline it, are the things that I need to look at. So that's the asset section. The next section that I need to look at are those liabilities and owner's equity. So in looking at the liabilities and owner's equity section, I would come in where I have assets here. I am just going to kind of come in and put liabilities in. So I look at my liability section. Liability section is going to also need to be broken up. It's going to break up into current liabilities and long-term liabilities. So just like I had the current liabilities here, if I come on down, I'm going to have current assets up top. I'm going to have the current liabilities section down here, and then I'd start listing out any of my current liabilities. So now I want to look at what I have on my sheet here. And so what I have accounts payable, notes payable, and salaries payable in this particular sheet. And what we want to look at is that this notes payable, we're going to say that this notes payable is a 3-year note. And if that's a 3-year note, that means that this is a long-term item. All right. Now the accounts payable is going to be a current liability. That salary payable needs to be paid off. That's going to be a current liability. So those items are going to go on our balance sheet in the current liabilities section. So if I look at accounts payable, it's valued at $3,500. So I'm going to come in here and I'm going to put my accounts payable in. Again, I'm going to start all the way over to the side, to the right side. So I do have my $, and that is going to be at $3,500. The other item that I see was that salary payable. So if I look at salary payable, and if you look at your worksheet, it is showing a $200 salary payable. So that is going to give me, if I indent over again, total current liabilities. And I add those together, that's going to be $3,700. I then would come in right underneath here and I'd put my long-term liabilities in. So I'm looking at long-term liabilities. That was that 3-year note. So I would have a note payable here. Other things that could be included, maybe a mortgage payable, different things like that would be, this case I only have the one. I am going to kind of indent over here though, just to show you what it would look like if I had multiple items. That is valued at $8,200. And so then I would have my total long-term liabilities. Add that, move that total over here. And then now I'm at a place where I can do my total liabilities. And so my total liabilities would be the current liabilities plus the long-term liabilities. So I would underline that because I need to add these two items together. And so I get $11,900. Now the next thing I am looking at is the capital. So if I come in here and I'm looking at that owner's equity part, the owner's equity part is going to be showing that capital account, and so I would list out the capital. Now remember, the capital account, what I'm using for the capital account is what I had on that statement of owner's equity. So on the statement of owner's equity, remember I had $11,200, so that is the amount that I am going to show here, is that $11,200 amount. So when I finish everything out, I am going to have total liabilities and owner's equity. I'm going to take the total liability, add it to my capital account. When I do that, I'm going to end up with $23,100. I will underline that, double underline that, and put a dollar sign there because I am finishing that statement. Again, that is coming from that statement of owner's equity, so just make sure, don't want that to look like anything there. It's coming from that statement of owner's equity, so just remember that that is where you are getting that from. Whenever you are finished with all of this, the thing that you need to make sure of is that your total assets do in fact equal your total liabilities and owner's equity. So that should equal. If it does not equal, that means that you've got something somewhere that's not adding up like it is supposed to add up. So just make sure that all of that equals and that all of that is what it needs to be. And that really completes what we're looking at as far as the income statement, the statement of owner's equity, and that classified balance sheet.